Welcome back to the channel. This is Anthony, and today let's break down exactly why Amazon dropped about 15% today after its earnings were reported last night. Well, firstly, I'll break down some of the numbers, and then I'll go into what this means going forward with Amazon stock. So for this quarter, they reported a revenue of $116 billion, which is about 7% higher than the revenue that they reported last year at the same time. But still slightly under what analysts were expecting of about 9% growth year over year. Unfortunately, Amazon reported a net loss of $3.8 billion compared to last year at this time when they made a profit of about $8.1 billion. Analysts in this quarter were only expecting about $4.4 billion, so to show a loss of about 3.8 is massive. Now, the company itself is not totally to blame on why they lost so much this quarter. But they attribute this loss mainly due to their $7.6 billion loss in their investment in Rivian. Which we know Rivian is an electric car company, and they know that Amazon bought a bunch of Rivian trucks for their Amazon Prime delivery. And since that investment, Rivian stock unfortunately has dropped about 75%. Having an investment in a company is volatile and can fluctuate greatly. So of course this isn't going to happen every single quarter going forward, which actually if we got rid of the Rivian loss altogether, Amazon would have reported a net income of around $4 billion, which was right in line with what analysts expected. The CFO of Amazon also stated that inflation and fuel prices and just labor constraints all attributed to about $2 billion extra in this quarter. And one of the most important metrics that investors are listening to on the earnings call is guidance. Guidance is pretty much what the company is projecting for the quarters to come. And they actually cut their revenue guidance for the next quarter from 11% down to just 5%. And while their AWS business has actually been growing fairly well, considerably, about 34% over last year, analysts and investors are looking at the core of the business. How much are they actually making on operations with having these products made or distributed and then sold to us? And in one of their financial statements, they mentioned that at this time, they are no longer looking to increase the size of their physical locations or their staff capacity. And they're looking to make the company more efficient with what they already have, which I actually think is a pretty good idea, and to have any company that can work more efficiently and save dollars wherever they can. But unfortunately at this time, investors view this as a busted growth story. And they think that by Amazon saying this, it means that they are no longer going to keep growing locations and employees, meaning that the revenue will stagnate and no longer see that S-curve of which we once have seen with Amazon. Despite all of these pressures, they still are actually guiding for about 3 to 7% revenue growth over the next quarter, but unfortunately are guiding that they will make an operating loss of about $1 to $3 billion, compared to a $7 billion gain that they had in 2021. And just see how much money the company makes at its core once everything else is paid, with labor, with cost of buildings, distribution, all of that. Also, as well as a lot of analysts viewing this as a stock in a company that benefited a lot from staying at home orders from the pandemic, which initially was a tailwind because with everyone staying at home, there was a lot more people buying products or getting their groceries through same day delivery with Amazon, and overall just less people wanting to go out into public to buy their toilet paper or what have you, which now they are viewing as a headwind for the company because they're not able to match demand that once was since we were all at home. Now, while it does seem like all of this information is bad, and of course the initial reaction is always going to be the worst, seeing a 15% drop in a day for Amazon, which I think is like the worst in 8 years. I think at the end of the day, Amazon is a very mature company. They have customer loyalty. They're one of the most efficient companies on the planet. Considering how quickly Amazon scaled and was able to outperform some of the biggest retailers in the world, such as like Walmart or Target. And now Amazon is pretty much the fastest distributor of products in the retail space in the world. And while some view it as a busted growth story, I think it's very smart that they're going to buckle down with what they have right now and maybe try to vertically integrate their company the best that they can. Meaning that they're probably going to look at a lot of inefficiencies within the company to see where they can cut back on spending and thus increase their profits over time. And where the stock is right now, which is now lower than its 52-week low, I think over the next few quarters are going to tell a better story about what's going to happen to Amazon going forward. And don't forget that the mean target price for most analysts out there is about $4,000 a share. So it doesn't mean look blindly if you do hold shares in the company, but definitely pay some focus on how much they're expanding their revenue every single month and where they're cutting back in their expenses and seeing if their operating income goes up. If those two numbers don't improve and it seems that there's more inflationary issues that they're not able to counteract, then we can look again and review the numbers to see if this is a stock that we want to hold long term. Let me know what you guys think in the comments below. Are you selling these shares, or are you buying the dip, or are you just holding for now? But with that said, thank you so much for watching, and I'll see you in the next one.